This is a continuation of the FASB conceptual framework videos, and it's on recognition and measurement. So let's go ahead and start off by looking at the conceptual framework outline that we've seen before, driven by the objectives of financial reporting. We just completed the discussing the elements of financial statements, and now we're going on to recognition and measurement concepts. And the best way to describe this is that recognition and measurement concepts answer the question, when should economic transactions be recognized? And when I say recognized, that means recorded in the financial statements, and how should they be measured? So let's take a look at the criteria. Now, recognition is when an event or a transaction should be incorporated into the financial statements. So when we say we recognize something, that means we record something in the financial statements. Recognition criteria these are general criteria. So again, there can be specific criteria for events, but these are the general criteria that the conceptual framework follows. Number one, there has to be a definition. The item, that event or transaction, must meet the definition of an element in the financial statements, meaning we just can't go ahead recording everything. It has to be within the elements within the financial statements. Number two, it has to be measurable. Measurable with sufficient reliability. And we're going to go back to measurability in the next slide. We'll go over that a little bit more. It also has to be relevant. It must be relevant to making a decision. And again, decision within the context of useful information for third-party type of decision makers. Lastly, it must be reliable. It must display faithful representation, which includes the fact it's complete as a transaction. It's neutral, in other words, it hasn't had any type of political influences to manipulate the accounting, and free from error. Now, one very important point as we go through here is recognition, which we've just talked about. Recognition, which is the recording of the information into the financial records of the company. It is not the same as a concept of realization. So again, recognition is not the same as realization. Now we go on and we just talked about the recognition of an event. Now we need to talk about how do we measure an event once we decide to recognize it. And the conceptual framework talks about, we have to talk about what is our unit of measurement, which will be the dollar in this case. Number two, it says what is the attribute to be measured? How are we going to measure it? So the conceptual framework describes 5 different valid attributes of measurement. The first one is historical cost, which is the original cost, and everybody who's made a journal entry in any accounting textbook knows all about original cost. Another concept is called current cost, and that is the current cost to purchase the same or an equivalent asset, or a similar asset or equivalent asset to the asset we're looking at. Fair value is and that should be realizable value, not reliable value, but the realizable value of selling an asset in an orderly liquidation. And in other words, not emergency, but if we're just selling it as part of an orderly liquidation. Net realizable value is the net proceeds expected to be received from an asset in the normal course of business, minus any costs of completion and sales. Lastly, we have the concept of present value, which is the discounted value of cash flows. Now, at this point in time, most students go and say, well, wait a minute, you can't use all these type of values in accounting. That's just kind of crazy. And the truth of the matter is, if you step back and take a look at this, we use these all 5 of these values all the time in accounting measurements. Obviously, historical cost would be the case of depreciation, where we basically create a situation where we record a purchase of an asset at a particular cost, and then we're going to take that cost and depreciate that over the life of the asset. And again, that's also supported by the going concern concept. Also, if you take a look at, as an example, fair value, a lot of the financial assets under generally accepted accounting principles right now, you can revalue assets, financial assets, you can leave them at historical cost, or you can revalue them to fair value. We use net realizable value when we're valuing accounts receivable. When we're purchasing, when we're accounting for long-term bonds, we're not we're one of the methods of valuing those bonds is using discounted cash flows. And again, we use a premium or discount on bonds to adjust bonds to their cash flows to a discounted cash value. So you can see there's in this particular case, what the conceptual framework is doing is acknowledging that we used most of these attribute measurements in the past. We use them now, and the conceptual framework is saying that these are the attributes, or the valuation attributes we're going to be using in the future. Now let's look at the concept of revenue recognition. And again, recognition means when I actually record the transaction in the financial records of the company. And there has to be two general things that happen in order to recognize revenue. The revenue must be realized or realizable. What that means is when goods or services have been exchanged for cash or claims for cash. In other words, cash or credit type of sales. So that's realized or realizable. That is not the same as recognition. Okay? And also the revenue, in order to be recognized, the transaction, the revenue has to have been earned. What that means, generally speaking, when the earnings process has been substantially completed and the entity is entitled to the resulting benefits or the revenues. Now, I don't want to muddy up this issue, but we're going to see a number of exceptions to this that have occurred in the past regarding, if we take a look at installment method accounting or things like that, these don't really work in line with these conceptual framework terms, but they had occurred. These types of accounting had occurred prior to the conceptual framework, and we'll talk about that as we encounter them. Now, let's talk about the concepts of expense recognition. And the first one is expense. We recognize expenses as an example based upon the consumption of economic benefits. And that would be a case where, a good case for depreciation, where basically we purchase an asset and that is going to benefit us under a number of periods under the going concern concept. So what we do is we allocate the expense of that asset against the revenues that are being produced over those future economic benefits. Impairment. At sometimes an asset is in a situation where it can no longer provide the services we thought it would provide, so that asset becomes impaired, and we have to recognize that expense or loss of impairment at the time it becomes impaired. Another area is liabilities that are incurred or increased without the corresponding receipt of corresponding benefits. And an example of that would be if the company lost a lawsuit where now it is incurring a liability, it would have to recognize that liability at the time it occurred. And we're obviously receiving no benefits from that lawsuit. We're basically going to have to pay out a liability. Now, if we take a look at how we recognize expenses and losses, there's three major principles. The first one is what we call the matching principle. And the matching principle is synonymous with associating cause and effect, such as a direct relationship is found when the cost of goods sold is recognized in the same period as the revenue from the sale of goods, things like that. Also, there's something we call systematic or rational allocation. And in this case, we don't directly relate our costs to our revenues, but we apply them in a causal type of relationship, but we can't specifically identify it. And a good example of that would be depreciation. Also, we have this concept called immediate recognition, and that typically applies when costs cannot be directly or not even feasibly related to specific revenues. The benefits of these costs are used up in the period in which they're typically incurred. And a good example of that would be such as utilities expense. Now let's take a few minutes and go over 4 questions relating to recognition and measurement and the conceptual framework. Again, these are the type of questions you could encounter on the CPA exam. So let's go ahead and start with question number 1. Number 1, recording a capital asset at cost and then depreciating the asset over its useful life is an example of, and again, you want to select the best answer. So again, stop your video, take a look at your answers, and when you're done, go ahead, when you're done, you make your choice, go ahead and restart the video. Okay, number 1, recording a capital asset at cost and then depreciating the asset over its useful life is an example of, and as we talked about in the lecture part of the video here, B, going concern assumption. So in the absence of information to the contrary, we assume as accountants, when we're accounting for the entity, that the business entity will continue to operate indefinitely. And the going concern assumption provides us with a justification for measuring assets based upon their historical costs. If it were known that the enterprise would be ceasing operations very quickly or in the near future, we'd have to value assets and liabilities at their current liquidation values. But in this case, we can depreciate the assets using historical cost because we know that that entity is going to last, as we would assume, into some form of perpetuity. Let's take a look at question number 2. Number 2, a transaction being recorded in the financial statements is the concept of, and again, 4 choices. Stop the video. When you're ready, start it again. Number 2, a transaction being recorded in the financial statements is a concept of. B, recognition. Remember back to our lecture, recognition is when an event should be incorporated into the financial statements. That's what, or when it is incorporated into the financial statements. Let's go ahead and take a look at number 3. Under the FASB conceptual framework, which of the following is not recognized as a valid means of measuring a transaction? Stop your video. Okay, the answer to number 3 is under the FASB conceptual framework, which of the following is not recognized as a valid means of measuring a transaction, and the answer in this case is C. If you take a look at the Valid attributes of measurement, fair value is included, present value is included, current cost is included. The one thing that is not included is a term that was simply made up called mirror value. Okay, question number 4. Which of the following is not part of the criteria for transaction recognition under the FASB conceptual framework? Again, stop your video and select your answer. Okay, and the answer to number 4, which of the following is not part of the criteria for transaction recognition under the FASB conceptual framework? And the answer in this case is materiality. If we take a look at the different components, measurable would be a recognition criteria, relevant would be recognition criteria, and reliable or reliability would be recognition criteria. We don't have materiality as part of recognition criteria. Now that may be a part of decision usefulness, but it's not a part of recognition criteria. And with that, that's the end of this video lecture on recognition and measurement.